You hand over a thin piece of plastic, walk out with something you couldn't afford yesterday, and somehow feel richer than you did this morning. In 1958, a man named Frank McNamara sat in a New York restaurant, finished his meal, reached for his wallet, and realized he'd left it at home. His wife had to bring cash to bail him out, but the humiliation sparked an idea that would reshape how the world thinks about money. McNamara launched the Diners Club card, the first charge card that let people eat now and pay later, no cash required. Within a year, 20,000 people carried the card, and 200 establishments accepted it. Banks watched this unfold and saw something bigger than convenience. They saw a way to lend money without ever handing someone a dollar bill. By the mid-1960s, Bank of America mailed 60,000 unsolicited credit cards to residents in Fresno, California, launching what would become the Visa network. The experiment was chaotic. Fraud spiked, some people racked up debt they couldn't repay, and the bank lost money initially. But the concept worked, and soon other banks copied the model, mailing millions of cards across the country. You didn't have to apply. You just woke up one day and found a credit card in your mailbox, pre-approved, ready to use. What started as a solution to an embarrassing dinner became a system designed to make borrowing feel effortless. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. When you hand over cash, you feel the loss immediately. Your wallet gets lighter, the bills disappear, and your brain registers the transaction as pain. Researchers in the early 2000s used brain imaging to study people making purchases, and they found that paying with cash activates the same neural regions associated with physical pain. But when you swipe a credit card, that pain response diminishes. The brain doesn't register the same loss because nothing physical leaves your hand. This phenomenon, called the pain of paying, explains why people spend more when they use credit cards instead of cash. One study found that diners at a restaurant spent up to 83% more when they paid with plastic rather than paper money. Credit card companies understood this long before the science confirmed it, which is why they designed the experience to feel seamless. The cards are small, light, and easy to carry. They don't weigh you down or take up space like a wad of bills. Swiping or tapping takes less than a second, and you don't have to count anything, hand anything over, or wait for change. The transaction becomes abstract, numbers on a screen instead of money leaving your possession. You walk away with your purchase, and the only reminder that you spent anything is a signature or a PIN you'll forget 5 minutes later. Retailers know this too, which is why they encourage card payments. The easier it is for you to spend, the more you buy. By 2020, nearly 80% of all transactions in the United States were made with cards or digital payments, and cash had become the exception, not the rule. Maria opened her first credit card at 23 after a bank representative approached her at a college football game with a free t-shirt and a promise of 0 fees for the first year. She used it for textbooks, groceries, and gas, telling herself she'd pay it off when she graduated and got a real job. But graduation came with student loans, a low-paying entry-level position, and rent that ate half her paycheck. The minimum payment on her card was just $50 a month, so she paid that and kept using the card for emergencies, car repairs, a broken laptop, a medical bill. After 2 years, her balance had climbed to $7,000, and she was paying more in interest each month than she was reducing the principal. The credit card company didn't call to warn her. They just kept accepting her payments and charging her 23% annual interest. At that rate, if she only paid the minimum, it would take her over 30 years to clear the debt, and she'd pay more than $14,000 in interest alone. She wasn't reckless or financially illiterate. She was doing what millions of Americans do every year. By 2023, total credit card debt in the United States surpassed $1 trillion, with the average cardholder owing over $6,000. The system isn't designed to trap you, but it's designed to make borrowing so easy that many people end up trapped anyway. Banks make the most money not from people who pay their balances in full, but from those who carry debt month after month. In 2022, American consumers paid over $120 billion in credit card interest and fees, money that didn't buy them anything, it just serviced the debt. Credit cards aren't inherently evil. They've helped millions of people build credit histories, smooth out cash flow problems, and access funds in genuine emergencies. A person with no credit history can't rent an apartment, lease a car, or get approved for a mortgage, and credit cards offer a simple path to establish that record. Rewards programs give back billions in cash, points, and travel benefits to those who pay off their balances each month. But the industry's profit model depends on a different group, the roughly half of cardholders who don't pay in full and instead revolve their balances. These users subsidize the rewards for everyone else, paying interest that funds the cash back, miles, and perks that responsible users enjoy. It's a system that rewards financial discipline with benefits while quietly extracting wealth from those who struggle. The ease of spending with plastic has reshaped entire industries. Restaurants no longer need to keep large cash registers. Retailers can process thousands of transactions instantly, and online shopping wouldn't exist without card payments. But that same ease makes it harder to feel the weight of spending, and millions of people now live in a state of perpetual borrowing, never quite catching up. Financial advisors often tell people to cut up their cards or freeze them in blocks of ice, treating plastic like an addiction rather than a tool. And in some ways, that comparison fits. The convenience becomes compulsive, the rewards feel like incentives, and the balance grows without you noticing until it's too late. You can't uninvent credit cards, and most people wouldn't want to. They're woven into the fabric of modern commerce. But understanding how they work, not just the mechanics of interest rates, but the psychology of why plastic feels different from paper, gives you a chance to use them without letting them use you. The thin piece of plastic that makes you feel richer isn't magic. It's just borrowing dressed up as convenience, and the trick only works if you forget what's actually happening.